Iris Kupperman, Kuppy, what's going on, man? It's great to have you back on the podcast.
Hey, thanks for having me back.
Well, I follow you all the time. I think it's been like a year since you came on, and I'd like to get you on even more, at least quarterly, because I love reading your tweets. I love your research. And I want to start out because of the new revolution that we're seeing, which is called ESG, which stands for environmental, social, and governance. And you know where I'm going with this because you have a different meaning for it, don't you?
Yeah. I see it a little differently. I think it means energy stops growing. The world runs on energy. I mean, since the Industrial Revolution. Well, I mean, since humans learned how to play with fire and they needed wood. I mean, society runs on energy. And so if you put a bunch of regulations in place and stop the growth of energy, or maybe even make energy usage shrink, well, it seems what the plan is, and that should be pretty good for energy prices, I think, because I don't think the demand's going to slow at all.
No, I think you're right, but have you seen anything like this before? Where I mean, it's small groups of people, right? When you're looking at Engine One for Exxon, you look at Chevron, especially the oil companies, where yeah, I think it's like a $50 million stake that these guys have, which is nothing in Exxon. However, they're able to convince people like BlackRock and other firms of trillions in assets in the management to support them. I mean, is this a fundamental shift where, look, you could agree with it, not agree with it, you could be pissed off and say it's BS, but it is going to have a significant impact on what these companies are going to do in the future.
Oh, yeah, absolutely. It's really dramatic. I mean, I think, let's unpack this into a few pieces. I mean, the first piece is that everyone looked at ETFs as being this sort of benign thing. They buy all 50 stocks, and it's a low-cost way for retired people to get a little bit of exposure to the market. Suddenly, 4 or 5 individuals control these, BlackRock and Vanguard. Suddenly, they wield unusually dramatic power at large corporations where, normally, 500, what's Exxon, $500 million company? Normally you wouldn't have people who could amass big enough stakes to influence the outcome. But here you have 3 or 4 people that control what's going to happen at the company. It's sort of terrifying, really, because no one voted for these people. No one asked if they, were the best for society. I mean, look, I'm a shareholder of some of these things, but I get no say. It's kind of just weird. So it's a terrifying development that I'd never thought ETFs would get to. I always thought ETFs would just be, focused on earning a few basis points for the owners, not, changing society. So that's the first thing. And I don't know where this is going. I mean, first it's coal, then they're after energy. I mean, what if they don't like, some other business? They could do almost anything. They could mandate anything. It's really quite scary. And I don't know. What thoughts do you have on that? I mean, obviously, I'm not the only one.
I mean, look, I'm a stock junkie. I've been doing this 25 years, and I just find it fascinating as someone that combs through, loves earnings season, combs through, try to find ideas. Every single company, right? Every single company has a portion of their quarterly presentation, if you're looking online or whatever, dedicated to ESG. Like they have to say it. If not, they're going to be attacked. So regardless of what they think in the situation, and that's what really pisses me off is regardless of how they believe in something, whether they believe it or not, they have to do it because they're so afraid of getting attacked. And that makes me think that their interests are not in the best interest of the shareholders, because that's not really, I want an energy company to drill more and generate more money, right? But if you're going to, if you can't do that, then it's change your thesis on the stock, right?
So this is a funny activist campaign, because normally activists could look at Exxon and say, hey, look, they've been paying too much dividend. They really need to repair the balance sheet. They really need to invest for growth. They, maybe they want a buyback instead of a dividend. There's a lot of things you could do as an activist shareholder that maybe you're right, maybe you're wrong in the direction you want to take the company, but you buy enough shares and you have a say and you influence the outcome. This is a situation where I'm not sure if the activist cares if the shares go up or not. They're doing this to grandstand because they're launching their own ETF. It was good marketing. I don't think they actually care what happens to the company. It's the first case of activism I've ever seen from a shareholder. Then, they own a few basis points of the total equity. It's a rounding error. I've never seen that either. Normally, if you want to be an activist, you go out there and you buy a few percent of the company. I mean, I've never seen an activist like, General Electric. Those guys bought 2-3% of the company and they influence the outcome. But normally you have to buy, 10%, 20% of the company for people to take you serious that, you're actually going to get board members out there. The whole thing's bizarre. Someone else is probably behind this, and we'll never learn who, or maybe we will. But it's dramatically changed corporate America. And if they're doing that here, the rest of the world's only a few quarters behind.
Very, very true. And I know this impacted the oil industry because it could result in much less development in the industry, which looks like the way it's going, which is going to probably push prices a lot higher. We're so dependent on oil and natural gas, was 75, 80%, I think, just in the U.S. I mean, we would love to, not we, but you and I, but a lot of people would love to go to wind and solar and don't realize that it's not base load power. But it is going to be interesting what happens to this industry in particular. And let's talk about this industry when it comes to energy. You were very, very early to this, and I'm a big fan of energy. I've researched the death for so many years, and decades actually. But when you came out, and this was very early stages of COVID, and I did a great job researching COVID tremendously in January, knowing he was definitely going to come here, just with the context I had in China and Italy and those lockdowns and stuff. I actually thought you were a little crazy to go that early. I'm like, all right, I know Kuppy likes like deep value and stuff, but you almost nailed it completely, right? And now you're seeing the massive gains, but based on what we're talking about here, it seems like oil prices could easily go a lot higher from here. Is it hard for you to buy stocks when they're up 300-400%? Because one, you benefited tremendously, but would you be adding to your positions here, which doesn't make sense on big winners? You want to take some off the table. I mean, what's the strategy here? Because it looks like that energy has another leg up here.
So I think there's another leg up. I mean, normally at this stage of the cycle, energy companies would be increasing their drilling budgets. And, with about a 2-year lag, you'll see a lot of supply come. And that's why it's a cyclical industry. It tends to oscillate from big boom to big bust. And, it's a tough industry to invest in, but it's very cyclical. But this time, I don't know if the drilling and capital expenditure cycle will kick off. I feel pretty confident in saying that, through crises and whatever else, energy demand grows between 1 million and 2 million barrels globally every year. It just, look at a chart of it, just keeps going up. I mean, last year was a little odd because of COVID, but I think we're going to be caught up to that 100 million we were before COVID started. And then it'll just keep growing 1 or 2. And with all the stimulus, maybe it grows 3. And I don't think the supply side's coming. And I think you're going to have a huge boom in energy prices. How do you play it? I mean, I don't think anything I'm saying is all that contrarian anymore. I think it's actually consensus, a little scary, but I don't see what changes it. I don't think people have really thought through the ramifications, though, because we've been living in a world since 2014 where oil has kind of been between 40 and 60, so no one really thinks about the price of oil in their day to day. But what if oil goes to 200? I think you might need something crazy to happen. How am I playing it? I own a couple oil stocks that I bought at the depths of the crisis. But honestly, I've been peeling a bit off here and there. I kind of worry that, you have a rogue court in Europe that attacked Shell. You have, executive orders here in the U.S. You have, Colorado passed an ordinance, made it harder to drill. I think, owning the producers is not the way to play it, though you will get some spectacular wins along the way. I own some energy services companies. I think offshore will come back in a major way, and no one's predicting that, because while the U.S. will make it harder for people to operate, I think you have countries that are poor that don't really care about carbon dioxide, and, West Africa, Guyana, Indonesia, all these places that are growing production, and at a higher oil price, they're just going to go produce, and they don't really care. So they can take these drill rigs that are in the Gulf of Mexico, and they're just going to mobilize them. And so a lot of the drilling companies, you could buy a bunch of that steel at 10, 20 cents in the dollar. And usually at the top of the cycle, it trades at, 2 or 3 times replacement cost. So, there's a big move from 10 to 20 to, I guess a 30 times move. So I own some of that. I own some other services. But the real way I'm playing this, I'm just buying oil calls. 2025 oil future oddly trades at 54, while the front month trades at 70, because everyone's expecting shale to ramp up and, for oil to basically readjust back to the 50s, where it's kind of been in its band for the last 6 years. And I don't think it's going to work that way. I think 6 months from now, people will start realizing that the supply response will be slow and the demand response will be more aggressive than people expect. And I think that part of the curve going out a few years will get really bid up. I mean, and because of the fact that it's currently backwardated, you can buy those calls very cheaply. So I bought a whole lot of those calls, and the thing I like about call options when vol is cheap is you know exactly how many dollars you're risking. I mean, oil went negative once in my life. Could do it again. Futures are very levered. You want to be careful. But, in the end, you buy those call options, you know how many dollars you're risking. And if it turns out like I think it's going to, they could be multi-baggers. And, I think it's a lot better than buying some producer where you get an executive order and suddenly, you get zeroed. Where, here, if they go out there and zero some producers, my oil calls just do better. Sometimes the simplicity of it all is the beauty.
Yeah, it makes sense. I love the way you're playing that too through the call options. And wow, I mean, deep offshore drillers. I remember that industry used to be Transocean, Noble. Those companies were great when oil prices were 90, 100 for several years over that stretch. But man, those guys have disappeared, and that's interesting industry to look at. I love that industry. So, I appreciate those ideas. I want to change tunes here because we're research guys, data guys. How are you looking at what's going on with the Reddit crowd? AMC, GameStop, Dogecoin events, and I'm to have the same reaction as you, right? I'm laughing, but for me, whenever I miss something, if I miss a trade in something, it's, I'm hard on myself. I'm like, okay, what did I miss? Is there a way to look at this industry? Because there's no denying the gains, the spectacular gains. I mean, so we could sit here and laugh and make fun, but if you're looking at the massive gains, is there a way for investors to capitalize this? Is just a BS trend? I mean, we know that the valuations don't even come. I mean, MKM Partners came out with their reiterated their $1 target price on AMC, and it was based on fundamentals. I'm like, what are these guys doing? I mean, you should raise it to at least $2, right? $1. Anyway, how do you view? Do you view it as, well, why am I missing this? What is this a fundamental change in the way people are going to invest, bring on more speculation to the market? Or is it like, hey, I'm avoiding this. This is totally BS. I'm just curious how you see this.
Well, obviously, it's just blatant speculation. It's not very different from buying Dogcoin or Titcoin, or I don't know which other coins are popular. They get popular for a few weeks and then they kind of fade away. And some people make a lot of money and some people lose a lot of money. But it's just a big video game in a way. Obviously, these are untethered to any sort of like fundamental value. In terms of how do you play them, I think this is for professionals to play at home and be very careful, and you play small. But things in motion tend to stay in motion for longer than you think. And I've been playing these on the long side. I'm terrified to short them. But volatility spikes dramatically, and there's money to be made playing them by selling straddles or selling strangles. There's a lot of ways you got to look at your option chain and see where vols are. But there's ways to make money by just selling volatility and taking a view that things will eventually mean revert. And I use the word eventually, kind of highlight that will eventually mean revert. And if you can stay with it long enough, you'll probably do okay. And in the history of life, if you sell, straddles on something with a 300 volatility, you're probably going to do okay. I'm not going to say that every one will work out, but if you do it small and diversified across a lot of these meme stocks, you're probably going to make some money. Because remember, these guys, they all have their, Robinhood accounts, and they're slinging 1 and 2 lots, and they don't really understand, volatility. They don't understand that how much they're overpaying. And so they're buying these things. And, if you're taking the other side of it, you're probably going to make some money, but you will get ran over sometimes. So please play small. Please be patient. But I don't know. So far, that's how I've been playing it. And, I'd say I make money on about 8 out of 10. And, 1 or 2 out of 10 really hurt bad. But net, I'm doing well.
And let's talk about that. Let's talk about your strategy, because which I love to do with great analysts like yourself. You see, it's based on 2 core principles. So identify a relatively small number of really exceptional companies that could increase more than 5-fold in the next 5 years. You say 5 and 5s, and also focus on company sectors undergoing some sort of inflection. Just based on that, to me, it shows me how many different styles of investing. I mean, it's top down, bottom up, right there. It's just, I'm sure you're not really focused on technicals, but sometimes you do if you're looking for inflection points. What does this lead to? Because if this is your strategy, for me, it looks like that you're really, really focusing on small caps.
I do a lot of small cap. I don't talk about it much just because I don't like to talk about small companies, but I do a lot of small caps, a lot of, our sweet spot's kind of in that like 100 to billion range. And, we're looking at stuff that's having some sort of inflection. Maybe it's a management change. Maybe it's an industry change. I look at a lot of cyclical sort of businesses, a lot of things that are having some sort of secular change. But there's a lot of cheap companies in this world, and there's a lot of really smart guys that have a Bloomberg and know how to scan for them. So just because it's cheap doesn't mean anything. You need to find something that's cheap that's things are getting better. I mean, Wall Street pays up dramatically when things are getting better. And when things are staying the same, but they're cheap, Wall Street just doesn't really care, Oh, great, it's 7 times earnings, I get a dividend, like who cares? It's when, you look at it and you have that FOMO of saying, wow, earnings are really going to grow next year. Like that's what gets Wall Street excited. And to have growth, you need either revenue growth or something happening on the cost side. But Wall Street really likes the revenue side. So you need something that's changing in the business. And that's what I'm trying to figure out. What's driving this and what's changing in the world around me. And I usually start with the top down. What's changing in the world around me? And then how do I play it? Energy prices going up. Got it. I know how to, now I go figure out how to play it. You look at any of the trends I've been in for the last, while. Copper prices up. Well, they're going to go drill and look for more copper. I'm going to buy some hard rock mining, exploration, drilling companies. They're going to do, this. I'm going to go find that. And then you look at the couple of companies in the industry, and I tend to buy, the guy that has the better balance sheet. So if I'm wrong, I don't get hurt too bad. I mean, obviously the guy with the worst balance sheet is the fulcrum security, and you have the most upside. But if I get my thesis right, I have enough upside. The whole point is how do you protect your downside? And that's by, making sure you have a clean balance sheet. And then from there, you just put it on, you kind of forget about it. This isn't rocket science.
And you don't use stops, right? So it's basically, if you really believe in a thesis and something comes down, a thesis is still intact, and maybe it's just taking a little bit longer because things, that pendulum could swing one way or the other way much, much further than anyone believes. Is it, hey, I'm just adding to position and staying patient with it? I mean, because that is discipline, right? I mean, that's not the easiest thing to do if you see something come down 30, 40, 50%, which was the case when I saw some people recommend oil, but they're up tremendously now. But, and usually good investors, great investors, I don't know if you agree with this, are usually a little bit early to their trades.
Oh, a lot early. No, I don't believe in stops. I believe in getting the thesis right, and I exit the position if I realize I got the thesis wrong. And, sometimes the stock is up and I go, wow, I got lucky. I got that totally wrong. And sometimes the stock is down and I go, wow, this thesis keeps improving. I'm just going to buy a lot more. And I'm focused on the thesis, not the stock price. Obviously, I look at charts. I'm not really a chart guy, but I understand enough to know that you don't want to buy a chart that keeps making new lows. You want to at least wait until it stops going down. Usually, it makes a little bit of a base or something. That's kind of what tells you, hey, it's safe to go now. But I really don't want to buy stuff that's making new lows, and I don't want to buy something that's up too much because then I'm paying for. It's already starting to get priced in. I want something that's stopped going down and it's just starting to curl. Is the word I use, where it's just starting to, make new highs, out of the base. And that's usually the indicator that I'm probably right about my thesis. And then from there, I just ride it. It's volatile and there'll be, shakeouts. There'll be these moments that really test your, resolve. But if you're right, you're right.
Yeah, no, I hear you. If you're right, you're right. Yes, I mean, we're wrong sometimes it could be a little painful, but yeah, I mean, sticking to that thesis. Yeah, I understand that it's most value investors do, right? Most value investors, listen, they believe in that thesis and they'll stick to it. But I love the fact that you said, look, you need to see something going on with the company that's changing it. Where if it's revenue, if it's earnings, an event driven, something's going to change. Where you see in that kind of growth because that's where the premium comes from. Great stuff there. Now. The easy question for you. Just go ahead.
So I was just going to say, I mean, usually in this macro stuff that I do, or I call it micro actually, because, macro is like interest rates and currencies, and micro is, how many dollars we spent in hard rock exploration next year, or how much, will be budgeted for offshore. Like those are micro trends. Normally what happens is by the time it starts showing up in the numbers, you're too late. You really got to see the trend and say, I see this happening. And in 6 months, it's going to show up in the numbers, but I see it starting to awaken. That's when I got to get involved. But by the time it's shown up in the numbers, if it shows up in the numbers, the stock's already doubled because a lot of these things are so depressed because everyone's saying, oh, offshore will never come back again. Mm-hmm. So as soon as people say, maybe it comes back, maybe not. Getting from never to maybe is like a 5-bagger,
Yes.
So you also don't want to buy it when it's never because, sometimes it's pitch black before sometimes it's darkest before it goes pitch black. So you want to make sure that you see there's some light on the horizon there.
No, definitely makes sense. And the easiest question for you right now is any sectors to share that are at an inflection point, because we've seen so many things get super depressed during COVID and are up tremendously now. I mean, I don't know. I mean, EVs is a story that's out there. ESG, we talked about, it could be agriculture. Even, for me, I'm not a gold bug at all, because people have been saying, the currencies and issues and debt and stuff like that since the 70s. It's the same thesis today. But if you really look at what's happening today, where inflation is going through, it's at a 25-year high inflation, and yet the Fed still pedal to the metal, interest rates at zero, which now real interest rates are at the lowest level since the 70s, which has to be very, very, very good for gold, I would think, at least something that has little limited risk and upside potential. But I don't want to sound like a gold bug, because I'm not, but I've positioned myself. But what are some of the things that you see? Is there something out there that you see as an inflection point? And I don't want you to give anything away that you're giving people will pay for your research for, but I was just curious.
Well, I think there's a lot of things that are at inflection points, and we're really early. I think U.S. housing has, there was a decade-long period where house construction was below trend. I think there's a huge catch-up there. I think anyone in the supply chain to housing, I think anyone, anything touching housing is going to do very well. I think it's going to be a multi-year trend, and we're 9 months into it. The stocks have all doubled and tripled, but, on the way to a 10-bagger, you double and triple. I think the reopening trade is a great one. All these companies in the U.S. have gone, absolutely crazy with the reopening trade in terms of price action. And so, I don't know if there's anything to do there, but go overseas. I mean, the same things that worked here in the U.S., a lot of the places, in Europe, they're like 2 months behind America in terms of, they're like 2 quarters behind America in terms of reopening. So, casinos, hotels, restaurants, auto rental, like anything that touches basically living normal life, those companies are all still just, depressed. Go to Latin America. There's been really no reopening trade there yet. I think reopening is going to be a Q3 story there. Like, basically, look at what worked in America and just copy it. It's been one of the best trades we've had, actually, by just copying what worked here and buying all the ones that aren't up yet in funny countries. I think hard rock drilling, guys doing exploration, it's been, really 30, 40 years where they haven't had any reserve replacement globally. And those reserves are going to have to get replaced. You don't really have a mine if you don't have your reserves. I think that reserve replacement is going to be a huge trade. And, there's going to be tens of billions spent on reserve replacement. And, you don't replace reserves when the price of copper is 2. You do it when it's 4.5. So I think that's going to be another great one. I'm just going through what we have here. I mean, obviously, this is the normal stuff that everyone's focused on, but those things are already priced like they've succeeded, and the jury's still out, Oil services, I think, are going to do just great. I mean, I have bits and pieces of the whole oil services supply chain. But those are the trends I'm really, focused on right now. Ag. I think ag prices are probably going to be structurally higher for a while. Basically, anything commodity related is going to do great, because you have these, like we talked about at the start of the show, you have these government mandated restrictions on production. It's easy to look at what's happening with oil, but the same thing's happening with almost any commodity product. Mm-hmm. And so there's going to be shortages everywhere, and the global population keeps growing and getting wealthier, so they want more stuff. And, there's 6 billion people that want the stuff that the billion of us already have. And so as that trend keeps going, it's a trend that's been going for 100 years. But as that trend keeps going, I think you're going to see demand increase. I think commodities do the sine curve thing. You get like 5 good years every 20, and we're into the 5 good ones now. So I like all that sort of stuff. But I don't know. That's the sort of stuff I'm focused on. Every couple of quarters I get excited about something. But the great thing about this industry, investing, is that you don't have to have a lot of epiphanies. You kind of need like one smart idea every year. Mm-hmm. And, the hardest thing actually is to look at a lot of things and go, nah, I'd rather just sit in cash. Something better will come along. I think that's the hardest thing, just sitting in cash and saying, nah. And so when the market's gone straight up for a year, I'm much more prone to say, nah, And in March, when everyone was panic selling, I was saying I got to buy stuff, buy stuff, buy stuff, and there'll be a time again the next few months, maybe a few quarters, where you can go buy stuff and feel really smart again. But I like to be buying stuff when they kind of give stuff away. I don't like being chasing. That's just how I play.
Yeah, no, I love it. And what about on the short side, right? I mean, we talk about the opposite of inflection points, but you're looking at, and I think that you've done some work with Citron, and I know Citron's not, they're like, all right, enough of the short stuff. It's so hard to short companies, but you're looking at technology which has been selling off. You're looking at some of these ESG names that ran up tremendously that are down 30-40% from their highs. And you mentioned SPACs, right? And that you identified on your Twitter page that, you're seeing these major unlocks of these insider shares, which is, going to create huge selling pressure. Is that something too? Or what's your allocation in terms of long to short? Do you go short like big positions when you want to? Do you think the market's high? Or is it just like, hey, these are certain situations that are going to put, some money on the short side here?
So I don't short much. I mean, I have this thesis called Project Zimbabwe, which kind of says that our Federal Reserve will do to us like they did in Zimbabwe. And the stock market in Zimbabwe basically went straight up, one of thousands of times. And so you don't want to be short if you know the market's going higher or you think the market's going higher. Sometimes I selectively put a little, tiny short here and there. But, most people short because they feel like it's their job as a hedge fund. And I don't see why you have to hedge if there's nothing worth hedging. If you think, I think the most underpriced asset's probably the 1,000 strike SPY call. I think we're going straight up. There's going to be a lot of volatility, but I'm not smart enough to know how to time it. And so if you think the market's going to be higher in 3 months, 6 months, 2 years, like what's the point of shorting it? I see a lot of my friends wasting a lot of their money and a lot of their energy trying to short stuff. And, just like the meme stocks don't really make sense from a valuation, neither do a lot of other companies. So, what's the point of shorting? Obviously, you have these SPACs, they're unlocking. You have this moment in time where a lot of shares are hitting the tape. And, if you look at it from, an odds perspective, if there's a lot of sellers and probably not a lot of buyers, they'll go down. And I've made some money there. But I think it's easier things to do on the long side. That's really where I'm putting my attention. We have this thing I'd like to talk about called Kettum. It stands for Kuppy's Event-Driven Monitor, and it tracks.
Before you go any further,
yeah,
I saw this KEDM. Venture Capitalism is your website. This isn't some pump thing, and I'm hyping this up, but you call it institutional idea generation for event-driven special situations, which, that name kind of like, all right, let me take a look at it, all right. It makes you not want to take a look at it a little bit. I went into this and it's free, and I went in there, and this must be one of the best things I've seen in terms of research, and you do it weekly. Explain it, because the amount of idea generation and everything, it's just incredible. I haven't seen a product like that. And I'm not even kidding. I've seen millions of products. I really, really, I just spent like 45 minutes just going through the whole thing.
I appreciate it. I'm glad you enjoy it. I mean, look, I never set out to be in the publishing business. I run a hedge fund. That's my job. But I wanted this data, and it didn't exist. And, I do a lot of event-driven stuff, because when you're looking for inflections, the most important inflections are corporate events. You have a CEO get fired, and the new guy comes in. He comes with a new set of eyes, a new vision, a new strategy. Like, there's an inflection in the business. People look at spinoffs and stuff, but that's all been picked over now. But there's a ton of these other sort of corporate events that lead to an inflection in the business, and I felt like I needed a way to keep track of all these. And so I asked a friend of mine if he'd come work with me and start producing this. And, him and I, we thought he'd just build an API and download the data from Bloomberg and we'd be done. And what we realized that a lot of the data that we wanted doesn't actually exist. He had to actually manually create it. And then, the data's buggy. And, we were surprised how much time it took, and kind of realized that we needed more eyeballs, actually, because I need a few people to do this. And so if you need a few people to do this, it starts getting, kind of expensive for a research budget. We're a small fund. And so I said, let's build this into something that we could sell. And because if I want this data, probably other people do. And if enough people get together, maybe it'll be a little business that's profitable, or maybe I'll just, lose less money collecting this data, but I want the data. And so we launched this thing called Kuppy's Event-Driven Monitor. It started as a free thing that I've been sending to some of my friends. And, eventually we opened it up to everyone, because I figured other people would want it. And, it's free right now. Go to kedm.com and sign up. it shows up in your mailbox every Saturday. We intend to put it down a paywall pretty soon and charge for it, just because, like I said, I'm looking to hire a couple guys and someone's got to pay for them. I can't do this pro bono forever. But you were talking about the unlocks, and we track those unlocks. We're going to get a lot better at tracking the unlocks. Actually, that's our first project when we hire new people, and I think there's a lot of alpha there over short periods of time in terms of with an unlock. Let me explain what that is. That's when founders or insiders have shares that after an IPO or a SPAC, those shares are restricted; they can't be sold. And then the unlock is when those shares can now be sold. And a lot of people, they've owned the stock for many years, or they're a PE fund or a venture capital fund, and their job is basically to buy and sell shares. And when they can get out, they get out. And so you have this period of time where there's extra pressure on the stock, and it tends to be a lot of money to be made by shorting the stock a few weeks before and covering when all the selling happens. It's not rocket science; it's supply demand. And so we track that plus a couple dozen other strategies, and we're looking to add another 25 or so in the next year to just track all these sort of corporate events and make money. So I hope you all sign up, KEDM.com.
There's no way that you're going to be able to continue to do. It's a 100-page report every week. And again, I mean, it highlights new ideas, including short squeeze candidates, which is part of the Reddit. You talk about, an ARC indicator, the Kathy Wood monitor, CEO changes, left for dead names, spinoffs, fallen angels, just all the events that happen on a weekly basis over 100 pages. I'm like, man, this guy's, you definitely have to charge for that. It really, really is amazing. I think I'll open it for free, but I have no idea. I mean, I know it's charts and figures, and you could have a couple guys do it, but the amount of information that you have there for a 100-page report that really, it's almost like a jump start where you can really get ahead of what's happening for the week and certain ideas and what's going to move the markets. But just the way you lay it out there, it's again, I'm not getting paid for this, guys. I was really impressed. You're like, hey, just mention this KEDM, and I'm like, holy cow, this guy, he's not charging for this thing.
I appreciate it. I mean, let me flag something. Like, we had this situation that was flagged. It's Anglo-American spun off their thermal coal assets because ESG, mm-hmm. And so Anglo-American's a big mining company, global mining company that did a spin-off of their thermal coal assets in South Africa. Who is the investor who has a mandate to buy thermal coal in South Africa? Nobody. And so, for every 10 shares you owned of Anglo-American, you got one share of this company called Thungela. And, a lot of the shares are owned by ETFs, so they just immediately sell it. And, a bunch of the shares of Anglo-Americans owned by, funds that have ESG mandates, they sold it. Pretty much everyone, the day they got it, sold it. And so yesterday the stock opened for trading, and it was trading about 110p in the UK. And they had 95p of cash, no debt. And so, this thing is trading at, 15, 20% premium to the cash balance. And it was trading at less than 1 times cash flow. But on EV basis, it's trading at like a tenth of 1 times cash flow. And so I bought a lot. And I bought them at about 115. It closed today at 150. So day 2, it's already up about 40%. I don't know where it goes tomorrow, but it's really cheap. And here's a company that's north of a $200 million market cap company. It's reasonably liquid, trades, $10 million US a day. And we flagged it in Kettum. We wrote about it 3 weeks in a row, said this is going to be a situation where there's all these structural forces that'll make this thing really, really cheap in the first couple of days. And it pretty much happened exactly as we expected it. And, our hope is, it's not every week you're going to have a great trading idea, but, I think that every, month or two, once a quarter, we'll flag something that ought to be able to pay for a full subscription, and so that's kind of what we're trying to do. Without Kettum, I would never have known about this because I'm not tracking South Africa and coal companies. It's the one that would have slipped through the cracks. It may be a lot of money. And I hope there's going to be many more found.
Yeah, I mean, the bottom line, too, is through your contacts or my contacts, of being in this industry for a long time. I mean, the goal is to see as many ideas as possible. And just seeing this report, and it just provides those, idea generation, which we're all seeking, and especially in the market now, because every stock you look at, it's up to 300% off its lows, it feels like, especially in some of these sectors, energies, financials. But just fantastic job with that. You go to your website, Adventures in Capitalism, and what is your Twitter handle? So you can give that out as well, because I know people are going to want to follow. You are definitely entertaining. So
thanks, appreciate it. I mean, my Twitter handle is at @Kuppy. Look, I try to be entertaining. Twitter is just meant to have fun, but I use Twitter also. on the idea side, you throw something out there, and I've got, over 20,000 followers. It's probably someone who knows something about the company that'll write something. And I go, hadn't thought of that. It's just a great way to, just test an idea and see what other people are thinking. But most of the time, I'm just, making fun of dumb stuff, because most of finance is pretty dumb. Honestly, it's amazing that you have people wearing suits doing this, because it's really just pretty stupid. But the whole beauty of the stupidity is that you just sit there and keep your wits about you, and every couple of months, someone will do something just so amazingly stupid that you say, "I'm going to take the other side of that." And then you make a lot of money. And most of the time, you try not to think too hard, because, I think the mistake most people make is they try to, say, "Oh, I got to be fully invested," or "I always have to have, a new idea this week." Or, nah, that's not the way it works. You basically just have a lot of fun and laugh at the stupidity around you. And every once in a while, it's just completely obvious. You make a lot of money.
No. I hear you, man. So listen, Kuppy, thank you so much for coming on. Last time you were on, we got tons and tons of views. So you got a lot of fans out there. You're one of the guys out there. And I'm critical too, that I follow religiously, that I love your research. I love your style of investing. It's fantastic. And keep doing what you're doing, man. It's a lot of people, a lot of big fans you have. And thank you so much for coming on, man.
Hey, appreciate it. Thanks for having me back on. Let's do this again next year.
You got it.